Hello guys, this is Punit and I'm planning to do a daily review at the end of the day of Indian markets as well as US markets. So this will be the Indian section. So to begin with, if we see the opening today, it was a huge bull bar closing near its high, followed by another decent kind of bull bar, but then the third bar didn't close all the way. It didn't even close beyond its midpoint. So that's a weak bull bar. But if you see the Nifty Banks chart, this did close very strongly. All the three bars closed strongly, and there is a setup called three bar setup, three bar breakout setup, which means that if you see three strong closing bars, be it bull bars consecutively or three bear bars consecutively, you can buy the close of the third bar and place your stop loss one tick below the starting point of the breakout for a measurement target of 1 hour. So again, if we go to Nifty's chart, you can see that this bar, the third bar, this is just a Fibonacci extension, and this is the 50% mark. And if you see, it didn't even reach the it didn't even close beyond its 50%. So technically, we cannot call this a very strong closing bull bar. Even a decent closing bull bar will close above its midpoint. There are traders who take 2 bar breakout entries, and those work too. I just prefer 3 bar breakouts, and that's just a personal preference. And later on, if you see, some bulls exited for a small profit, whoever bought on the first bar or on the second bar beyond this bear bar. That is why you see a pullback here. Although we are below the EMA, 20 EMA, price still formed H1 and H2. If you don't know what H1 and H2 is, it's just that we got a bull breakout and now the price is trying to move up or resume its prior trend twice. So this was the first attempt of it trying to move higher. You can see that this was the bull bar and it moved beyond this bull bar's high, and then it reversed again, and in the same bar it tried to move again higher, and then on the next bar you can see that it moved beyond this high. So bar 8's high got taken out by bar 9, and then again you can see that it went below the bar 9's low and then reversed up again, and on the bar 11 we can see that it moved beyond the bar 10's high. So this is the H2 setup. H2 is just a pullback structure. When price does something in your favor twice, meaning if you're a bull and it's trying to do a higher low structure twice, then it's a good entry. So like I said, this 3 bar breakout has a high probability of success too. If you see the Nifty bank chart, this structure has a probability of success around 60 to 70%, whereas the pullback structure varies from 40 to 60%. Why does it vary from 40 to 60%? There are various factors affecting it. Depending upon how good the pullback itself was within the structure. If you see here, the pullback started around this bar physically, but technically this bar, this long tail bull bar, was also a pullback on a lower time frame. If you go to 1 minute chart, and yes, if you see here, that huge tail was a combination of this pullback and a reversal up again. So on some time frame it was a pullback bar, some lower time frame. So this entire structure will be considered as a pullback structure, and what is happening within that structure matters a lot. Here if you see 1, 2, 3 bear bars, although they are not very strong closing, it's still 3 bear bars, and we are still below the EMA. So I would say this is just a 50% probability trade. You can enter one tick above this high, place your stop loss here beyond the low of the entry candle, or the signal candle, or the entire structure's low, and aim for a 2-hour risk to reward profit target. So it did reach 2.04, and this is just the Nifty 50 index. If we go to Nifty futures, I guess it reached there too. It reached 2.65. That's good enough. And then this was a deep pullback after the breakout above EMA. We can see that the price is trying to move higher here, here, and here. So this is three pushes down. So technically, this is a wedge bottom. What is a wedge bottom? It's just a channel which is converging in nature. Channels are usually parallel to each other. If you suppose price was moving in this bull channel, price is making higher, higher, low, higher, higher, low, with somewhat a parallel line between this two channel lines. But in a wedge pattern, it will usually form a converging pattern. Although this is not very good looking converging pattern, it's a, if you extend this lines, you will find out that it's converging very farther away. So why wedge patterns are important? I just told you that if the price is doing something for you twice or against you twice, then it's better to move in that direction. Suppose this was a you were hoping to get a long trade here, hoping for a pullback structure, and we didn't get a second time upward movement, but instead we got a second time lower movement. I would be going short there. Why? Because price tried to do something twice for the bears. So although I wanted to find a setup in the long side, we found a setup by the market in the on the short side. We will do what the market tells and we will go short. Here if you see, price tried to move higher here second time and the third time. So this is a wedge bottom. You can enter one tick above this bar and put your stop loss here and hope for a 1:1 risk to reward. Why 1:1 risk to reward? Although this is in the, we are trading in the direction of trend. If bulls were all that strong, they wouldn't let the price fall all the way from here to here. Why is that important? Although it's a bull trend, it shows that they're not very aggressive. So we cannot be aggressive on our profit taking either. I mean, we have to be aggressive on our profit taking and not hope for a 2 hour or 3 hour or something like that. And wedge bottoms have a high probability of, wedge bottoms or tops have a high probability of success. 60 to 75% of the times it wins. So it's better to scalp out than to swing. Usually it will go to the high. If it's a wedge bottom, it will go to the high of the starting point of the wedge. Meaning, suppose this was our wedge bottom and we entered somewhere here, the price will at least go to this point where the wedge channel started. So here if you see, back then I marked this as the wedge channel top side, so it will reach at least here. It did reach at least here and then we will exit there. Suppose the wedge pattern started all the way here, then would have been, then it's good to exit there depending upon your risk tolerance. I would exit some at some of my shares or position size at 1 hour, then the rest at the top of the wedge channel. Now coming here again, if you see, this is a micro wedge again, micro wedge top, moving higher, trying to go lower again, moving higher, then a pause bar. This pause bar, although it didn't try to go lower, it's still a pause bar. So I would consider this as a second attempt at trying to go move lower, and then it tried to go higher again and failed the third time. And it also reached the profit target for wedge bottom bull buyers. If you don't want to be aggressive here and short here, which even I wouldn't, it's better to wait for a break below EMA. Why? Because now we have a trend, uptrend, leg 1, pullback structure, leg 2. Why is this important? It's important because if you go and backtest any of the time frame, be it 5 minutes, 15 minutes, 30 minutes, Market always moves in pairs, meaning there will be a breakout in one direction, then a pullback, and then a continuation in the second leg. After the second leg, the pullback will be much deeper, signaling that either a trading range might occur or a deeper pullback channel will occur. Meaning, if I have to draw some channel like this, you can trade in both directions that way. Why? If it's a strong breakout, you can only trade in the direction of the trend. But if the pullback is so deep and it's still moving higher, it's still forming higher high, higher lows, you can trade on both directions. You can on the top third region of the channel, you can look for short trades, and on the bottom third region of the channel, you can look for long trades. If it's a broad channel, here it turned out to be a trading range for the entire day, and if you see, the range is so small you can't even trade any in the last 3 hours, I guess. Yeah. So once it breaks below the CMA, what is happening essentially is bulls who entered on this strong bull bar hoping for a measure move up. What is a measure move? It's just a target. Suppose I entered on the close of this bar and put my stop loss here, or suppose I put my stop loss below this bull leg, and I'm hoping to get a 1:1 risk to reward. I'm hoping that it will reach all the way here. That is why I bought here, assuming that I bought here. So now we can see that it pulled back deeply, and suppose you're a good trader and you have been doing this for many years and you know how to scale in. This is a good place to scale in and exit at break even. Why at break even? You suppose you bought here some two contracts and here two contracts. Somewhere in the middle is going to be your break even price. So this will be your break even price. You will exit here for no loss. But I would suggest against anybody who's new to trading and scaling in, it's just better to keep one position size and understand what's the market's going to do and to gain experience in that. So now the market failed once to go in your direction, and it reached the break-even point if the scaling bulls got out here. So it's failing to do something in your favor twice. The same concept which I tried to explain to you in the pullback structure, it applies here too. So once it breaks below the EMA and 1, 2, 3, 4 bear bars closing near their lows, although these 3 bars are not as strong as this one, it's still a 4 consecutive bear bar channel, micro channel. So you can take a short trade one tick below this bar and put your stop loss here or here and hope for a 1:1 risk to reward. Why 1:1 risk to reward here again is the major trend has been bull trend, and 80% of the time markets have a momentum or inertia. So 80% of the time it's hard for it to change its direction suddenly, and 20% of the time when it happens you can see a V-shaped reversal or a V-shaped recovery happening. Since 20% is not that high, we would assume that it will go into a trading range or it will resist the change to a certain extent, but that doesn't mean that we cannot trade in the short side here. So I would exit at 1:1 risk to reward. Here if you see again, it did hit our 1:1 risk to reward target. So that's it for Nifty 5-minute time frame explanation for today. The rest of the day was just tight trading range. You cannot take any trades here. Even if you did take a double bottom trade here, it's logical to take this trade. You can call this a double bottom with this, and then the second attempt to move higher and enter one tick above this bull bar and hope for a measure move high at least to the day's high. It failed again. But that said, this is just a tight trading range. If you see around more than 12 bars have been in trading range, tight trading range that too. Once it breaks above this range, Okay, you can enter on here one tick above this bull bar and place your stop loss here, but then it didn't work out either. It's fine, it happens. You cannot expect to win all the trades. But if we come to 1 minute time frame, you can see here that the wedge concept works here too. So the concepts work on any time frame you choose, be it 1 minute, 30 seconds, 15 seconds, 5 minutes, an hourly time frame, daily chat, weekly chat, monthly chat. It doesn't matter what the time frame is. All that matters is what price is doing. So here if you see price try to move lower once, it went higher, tried to move lower twice, went higher, tried to move lower thrice, and then it printed an inside bar. What is an inside bar? This is the high of this candle, this is the low of this candle, and this candle's range, entire range, is within the range of this previous candle. So this candle is an inside candle. Inside candle counts as a second entry. What is a second entry? The same thing which I explained, trying to do something once and then trying to do something twice. This inside candle represents that trying to do something twice. It just works that way. Nobody knows why. So this inside bars low can be traded for a 1:1 risk to reward for a high probability, or you can wait for the target of wedge tops bottom. There, if you remember, for on the 5 minute time frame, I explained to you how it wedge bottom pattern, how it reaches the high of the wedge pattern. There on the 1 minute time frame, since it's a wedge top, it will reach the low of the wedge bottom. Sorry, wedge top, and it did reach there. Other than that, I would say this leg one pullback, leg two. So this will be considered the trading range. So yeah, that's all for today. Thank you.